Hello, welcome everyone to our Market Outlook webinar. Um, Good evening, good afternoon, and good morning to all of our audience from different parts of the world. And today's webinar will be hosted by Jabir, our Chief Strategist, and myself, Theo, CIO of Skybound Capital. We are trying to cover as much grounds as possible, but I can never imagine that we will be spending so much time on one single individual that will be dominating our webinar today, I think. So the topic of our session is 2025 Outlook and Q4 24 review. I think I'll start with the recap of Q4, which was very easy. The market went nowhere. Everyone was waiting for this single event, which is US presidential election. Market started to move right after the result come out. So equities were highlighted by this big Trump trade post-election result. Treasury yields steepened, or I should say normalized. I'll show you some graphs later, with the long end edging higher. US dollar continued to strengthen. But everything was centered around market expectations of Trump and Trump policies. Now, that was the recap or the review of Q4. There was nothing more to be said. And I'll hand over to Jabir to give you his view on how he anticipates Trump will move and what kind of policies that will be launched by Trump. What's the difference and similarities from this office compared to the last? Jabir.
Lovely. Thank you, Theo. And good morning, good afternoon, good evening, everybody. So, yeah, I mean, I think Theo gave a really good intro there. And in one sense, on the surface, you'd be forgiven for thinking that actually we've just got a repetition here of what happened in Trump's first term in office. And look, I mean, to an extent we have. I think one of the main differences this time is that he's come back in a more structured approach. It might never seem structured where Trump is concerned, but I think there is some sort of reason behind the madness, and he's had plenty of time to build for this. We will find out in the fullness of time to what extent he's really on a dedicated path to fix things for the US. In the true spirit of MAGA, Make America Great Again, or whether this is a vengeance path. For my part, I think there have been a lot of good things. There's certainly been a couple of very ominous things, but we'll see. So the focus undoubtedly has to be on tariffs. And sorry, can I just check? Can everybody see this? Yeah, you can. Yep. Yeah, okay. So
it's coming through.
The tariffs really are the main thing, because what happens with tariffs when you put a tariff on something, essentially it's a tax, and it's a tax on your incoming goods and or services. In this case, for the most part, it's around goods, but in some instances there are services as well, and it usually horrifies people because they think, okay, if you slam taxes on your imports, somebody has to bear that. And typical economic theory says, well, that's got to pass through. They call it the pass-through effect to the end consumer. Now, as I've said many times before, both in presentations and in writing, the US is the largest consumer nation in the world. It has a voracious appetite for buying, eating, drinking, anything, you name it. That's what keeps the economy going. Something like 80%, 70% at a household level, 80% if you include government spending, of its GDP is made up of consumption. It's actually a very enviable position to be in. So if you go slamming tariffs onto your incoming goods and services. Somebody has to feel it. So what this chart's trying to do is to say, if you look at the suspects in play here, clearly Mexico and Canada are the front runners. They've been given a bit of a reprieve lately. They were given a 30-day extension, if you like, to go away and come back. It's essentially it's just deal making. It's to give them a chance to come up with some proposals, how they can work it out. But otherwise, they're staring straight down the barrel of a 25% tariff gun. I don't think it'll come to that. And I think the proof of the pudding actually lies in China, because with China, it was a surprisingly clean instigation of a 10% all-round tariff. And as I said in my last week's weekly, I'm actually amazed that nobody's talking about this more, because if you remember during Trump's election campaign, the figure being touted was 50, 60%. So why on earth did it suddenly drop back to 10%? And I'll come on to that in a second. So these are the kind of goods we're talking about here, just to put some perspective. It's not a comprehensive list, but it gives you an idea of the kind of products that are being affected because of these tariffs. And right at the top line, delivery trucks. It's estimated by various sources that vehicles are going to see an increase, if it's passed through straight away, are going to see an increase of something like $3,000 a vehicle. Now, I mean, if we know Americans love their huge, great, big, fancy cars. I would seriously question to what extent, if that's the worst of it, which from what I'm seeing is the case, then frankly, $3,000 isn't going to break the back of an economy. That's my gut feel. I mean, and a lot of these things are done on the back of financing. If anything, we need to be more concerned about the financing costs, not the $3,000 itself. And then you look down that list, and you've got various other very sort of specific items there. If you look at the spread by states, I love this chart. This is just a visual capitalist chart. It actually shows state by state where the main reliance is, if you like. So the further north in terms of the US states, not surprisingly, you've got more Canada there. And then spread from east to west, or west to east, you've got a big influence from China. And then further down, again, not surprising, because it's so close to the Mexican border, the influence is on Mexico. And you can see the percentages there in terms of what they import. So the states are individually affected. And in fact, there was a recent comment from the Canadian leadership that said the individual states should be able to decide what they want to put up with, and to an extent they can actually in the US. It's the United States of America, which means they essentially have two levels of government. They have the national, the upper crust, in Congress, and then they have state by state. So it can get quite convoluted, and as you're probably familiar, some of the states have their own individual taxes as well that they apply to. This is actually one of the big propellants of migration within America. Forget from outside. People will move freely from state to state because of the taxation system. It's not just about where the jobs are. It's a very important thing. It's true. It's a true display of taxation in action. So if you then look at the real issue, because you got to ask yourself, if you look at the maths behind this, it's quite interesting. If Trump wants to finance his tax cuts, and what tax cuts are we talking about here? We're talking about corporation tax, which he's touting at 15%. That's what he wants to bring it down to. And there are some rules around that. It's for those companies that are bringing production back home. So he wants to encourage onshoring, reshoring even. And then there's the extension, the Tax Jobs Act, the extension of the income tax. Now, the corporation tax side of it is actually relatively small. It's the extension of income tax that's big. And if you put the two together, we're looking at a total cost of over 10 years, I'm talking about. Over 10 years, and it's now coming up for expiry. Therefore, it has to be rolled over, and that's what Trump wants to do. It's a cost of $200 billion per annum over 10 years. Now, if you look at the total taxes that he would potentially raise from tariffs, they don't come anywhere near close to covering that. No way, no, not a chance. So what is the end game here for Trump? And I think this slide alludes to a lot of it. To him, he sees this huge imbalance that lies at the heart, as the heading says, at the heart of global trade. The US consumes much more than it produces. China produces much more than it consumes. And Trump wants to change this. But I'm also sure that I'm pretty convinced that and Theo can comment on this later, but I'm pretty sure that China would like to change this as well. I mean, that's ultimately what China is trying to work towards. So the idea, the notion that this is a one-sided play, it might appear like that in the short term, but the reality is that we would have had horrendous inflation if this hadn't happened before. To me, the imbalances came about way back from the Bill Clinton era, when the whole WT saga started. It was never properly thought out. And as a result, there are lots of accusations. Some of it is warranted, that China has been dumping low-cost goods onto the shores of America, and particularly very recently in Europe. And that's why the Europeans are up in arms and they want to revamp the whole trade side. That's negotiation. That's pure negotiation. But this is a WTO thing. But when you look at that chart, it's pretty telling. In terms of their individual share of global manufacturing value add. Yeah, China has, you're looking at 1/3. The US, a lot less. He wants to go about correcting this. Tariffs are certainly one way, because what he's trying to do is to make domestic goods more competitive. It's a gamble. It's a very big gamble, but he does have leverage in the short term because America is such a big consumer nation. And when you're a big consumer nation, that means people who export to you are reliant on you. I mean, that's just typical classic game theory. The other headache is for the WTO. He's put them in a real tight corner, because look at the two biggest contributors to the WTO. It's the US and China. So, and followed again, not hugely far behind by Germany. So I have said in the past that I think Germany is a key market to watch. This is the key month, 23rd of Feb, when they have their elections. Let's see what Germany does on this front. And then behind Germany, you got Japan. But the two biggest contributors to the WTO budget, the US and China. So all we can do is to go on past precedent. Now, Trump had a first term in office and he tried something similar. As I said earlier, it wasn't thought out perhaps as well it has been this time around. But you can see the gold box there. That was the era in Trump's first term of tariffs. And this is looking at the impact on price inflation, core price inflation, not headline. You got the headline in red, the core in blue. Why the distinction? Because core is basically headline inflation minus food and energy. So the logic goes that core is much more representative. It's debatable, but it's much more representative of services inflation. And when you're a consumer nation, that's what you feel the impact of a lot more. And what you're seeing there is that after an initial hike in inflation, both inflations, they actually came down. So this is something I want to come back to in a second. Why did it come down? If you look at durable goods, so durable goods by definition is anything that is considered to last more than 3 years. So these are your classic sort of white goods type things. Yeah, your fridges, your washing machines, etc., etc. And during that time, it's the same story. It went up, and then it came down. So I'm going to propose one reason why this happened, which again hasn't been spoken about. I'm quite surprised by this. It's the impact of your own currency. This is looking at the general trade weighted dollar index. So by trade weighted, I mean it's a weighted average of the US dollar against a basket of different currencies. And you can see here that the dollar went up. Now, when your currency goes up, that makes your imported goods and services cheaper because it's costing you less dollars to buy those goods and services. And if you look at the most recent trend here, right up here, the dollar has really shot up lately. So I think he's got a bit of a comfort, a cushion there to actually implement these tariffs, knowing full well that we're not going to settle for 25%. We're going to settle much more for a Chinese style 10%. That's my gut feel. And on that basis, the dollar has easily matched that. So the net effect to the US is really negligible. So that's the first point. If you look at the breakdown of that currency appreciation against, so you in the blue line, the light blue line is a repetition of the first chart. Then you've got the dark blue line, which is against the advanced economies, and the purple line against the emerging market economies. It's the same trend across all three. The dollar has gone up. It went up before, and it's going up again. So there is a cushion effect. There's another factor here, which people don't really talk about, and I find it odd. I mean, I did a lot of Googling on this. I did a lot of chat GPTing on this. I did all kinds of, just searching around. What is the actual impact of tariffs on inflation in the end? We can all sit here and discuss theory, but what is the pass-through effect ultimately? A rule of thumb says that if you imposed tariffs of 20% on a pure pass-through basis, you result in 6% higher inflation. But the reality is a lot less. It's actually less than half. The first reason is what I've just cited, and that's as you're looking at it right now, that's the currency appreciation. The second is that between importers and exporters, they bear some of the brunt of this. They trim back because exporters don't want to lose market share. And neither do importers for that matter. So as far as they possibly can, they bear some of the cost. So when you factor all that in, oh, and by the way, there is potentially a third factor, and that's your small to mid-market economy, the small caps and the mid caps. They all start to kick in because whereas before they maybe didn't have the economies of scale, now suddenly it's starting to look a little bit more attractive for them. And that's something Trump really wants to promote. And then if you get the reshoring, those things take time. You don't just reshore your business overnight. So, these are things that take years. I mean, you're looking at minimum 3 years, I would say. More realistically, 4 or 5 years. Think about building a factory, whether you're starting from scratch or you're relocating the whole thing. You gotta find land. You got to negotiate leases. You've got to then import you got to then buy the capital expenditure. All of that, put it together, and then the whole construction process. This is not an overnight job. So you put all that together, and actual results show that the impact on inflation is a lot less. And this goes back to the previous chart here. That is why it starts to dip, because once you give it time to settle in, then it's not such a big deal. So the real issue here is not the imposition of tariffs. It's what level we settle at on the tariffs. This is the whole point. If you look at this chart, it's an interesting one because people say, oh, but it's going to have an impact on growth. Well, the Atlanta Fed, which is renowned for its own forecasts, they are now at almost 4% in their prediction of US GDP growth year on year for the first quarter of this year. Look how steep that has risen. And I had to look to see how accurate they are. They're actually not bad. They're pretty good in terms of the way they go about their forecasts. Here's the blue chip consensus. This is the danger with consensus. You sit around waiting for one analyst or economist to come out with a forecast, and then next minute they all follow like a herd of sheep. But when you actually dissect what's going on, it's a whole different ballgame. So, for what it's worth, I mean, there are no signs here that growth is going to fall off a cliff. I'm actually of the opposite view. I said in one of my weeklies, I think towards the end of last year, that whereas the consensus at that time was around, well, the best that I saw was 2.5% for this year. I said actually I think it's going to be closer to 3. Now you got the Atlanta Fed saying nope, we're going to be closer to 4. Call it 3.78, something like that, year on year for this quarter alone. Now it's going to fluctuate, obviously, quarter by quarter. It always does, but that's a big leap. It's the move that you should be really looking at here. So unless the Atlanta Fed has completely lost the plot and their economists have just lost it, it's that's a big jump. I've commented really on in terms of tax collection. In the initial set of tax takes from the tariffs, it pretty much doubled. It went from there to there. It will go up again this time as well. To what extent, we don't really know, but there will be an increase. And what impact did that have on markets? Well, the S&P actually fell, and it fell on the back of volatility. Now, I'm not going to go too much into this because I know Theo is going to talk about markets and stuff, so I'm going to leave that down to him. But obviously, the concern that people have is, okay, you've got tariffs, it creates volatility. Well, that is what's driven the S&P. It's created volatility. And because we got some really overpriced sectors right now, like tech, and I would question the degree to which people say it's overpriced. Because of that, it's almost like they look for an excuse to sell something off. This is pure psychology. It's nothing else. It's pure psychology. People are afraid when markets go up. Now, I get it if it's like the dot-com era. You had really crappy companies going up and up. They weren't making a profit. They had huge cash burn. They, after a while, starting to claim fictitious products. No wonder it all corrected. Anyone with half a brain cell knew that this thing was going to collapse. Today's picture is a very different picture. Most of these tech companies don't even need to go to market for funding. They've got their own cash. This is pure volatility talking. It's nothing else. There was no inflation. So why should it go down if inflation is the only reason? Dollar was strong. And as for the impact of a strong currency on exports, it's actually depending on the type of goods. I mean, if it's a luxury good, for instance, and you're selling, top quality cars, BMW, I mean, German car makers don't really have a problem when it comes to high quality cars. If you want a Merc, you will buy a Merc. And you're not going to be fussed around how much extra tax you're going to have to pay, whether it's costing you because of the currency effect or whether it's coming through in a tariff effect. If you want that Merc or Porsche or BMW, you will pay for it. It's as simple as that. Those are the goods you really want to be targeting. They're completely inelastic when it comes to pricing. And then just to sort of round off on the macro picture, what this chart is saying, quick sort of view of the world, taking certain variables, real spending growth, unemployment rate, and so on, is that the picture in those countries looks pretty good. It looks pretty good. For these two, the ones with an asterisk, unemployment rate and debt service ratio, you have to look at it from an inverse point of view. They do that so that they get it all on a level playing field. And actually, it's it's not an issue for the US and the Euro area or Japan. It's an issue for Canada, the UK, and Australia. Why? Because their mortgage markets are much more low duration now. They're heavily aligned to the variable mortgage rate market. And because interest rates have gone up, consumers are having to pay more for their mortgages. The impact elsewhere has been minimal. It's been really minimal. So the debt service ratio is pretty low for the likes of the US and the Euro area. Risk premia, if you look at that in terms of equity risk premia, in other words, how much do people want over and above what equities have been returning? They've actually been coming down. So there's no sign here that risk is a major impact on markets. And the same goes for bond yields. Bond yields are normally the first to react to anything. That's what we have on a daily basis. Whenever there's a fear around tariffs, it causes volatility. When there's volatility, bond yields hike. And what this is saying is that, for the most part, I mean, bond yields they haven't moved. I mean, they've actually come down. They've actually come down. All of these are very specific. In Japan, it's very much around wages going up and will the BOJ hike? Won't they hike? In Germany, it's around the volatility surrounding their political system right now. These are all very easily explainable. These are going in the opposite direction. Earnings, always important. What's the impact on earnings? We've had some, earnings have been going through a rough time. There's no doubt. I mean, if you look at earnings sentiment, it's not a pretty picture because I think there's here it is, as the name suggests, it's sentiment. It's how people feel, and to that extent, it can also be misleading. If companies are faced with problems, and I would argue there are a lot of geopolitical issues that they need to think about, Trump has added to that with the whole tariff story. Then you kind of have to wonder here. Well, what's happening on the earnings picture? Last one really, and that is Walmart. I said, why did they agree on 10% for China? Well,
Mm.
this is speculation, but Walmart, we know that Walmart imports directly 30 to 40% of its goods from China. That's directly. If you add in the indirect, in other words, it goes from China to, let's say, Vietnam or Malaysia or wherever, and then finds its way to the US, the figure is much higher. Walmart operates on wafer thin margins. It's around 3 to 4%. How are they going to pass on the cost? Because they can't absorb it from their margins. And this is what Trump is vehemently against. He does not want to see inflation rise. The whole pledge in the campaign was that. Walmart is a critical test. I think possibly one of the reasons they've come to this conclusion of 10% is this. So, look, I'll skip this one. That's a market thing. I'll let Theo focus on that. And I'll leave it at that. I'll stop sharing there. It's let you take over, Theo.
Thank you, Jabir, and I definitely will expand on the 10%. But before that, let me ask you a question.
Yeah.
Inflation,
Mm.
right? That definitely will weigh on market in the short term, and it's more inflation expectation. So my question for you will be the inflation expectation based on all these Trump expectations. Do you think that U.S. be it top line or core inflation will remain elevated or even at a higher level than what Fed anticipates, which would lead to potentially less rate cuts than market consensus forecast today? Or do you think actually some of his gadgets in his sleeves would allow him to potentially contain the inflation, bring it down further, and allowing Fed to start easing in a material way?
I certainly think that he's got some tactics to bring down headline inflation. Um, the most notable one being oil prices. He's totally committed to that. So we know he's not exactly Mr. Green. So he's pulled out of the Paris Accord, etc., etc. He's reopened channels for drilling in Alaska and other parts. He wants to flood the market in terms of oil and bring down pump prices. That's what Americans feel the most. So I think he'll definitely be able to bring down headline inflation, and I think he'll be able to do it in a meaningful way. Um, I think the one challenge he's going to have is on core inflation. Let's just call it services inflation to keep it simple. I think on that he's going to have a challenge and I think also he's underestimated that, because if you free up energy costs and give consumers more to spend, you know what Americans are going to do. They're going to spend. So I think that will remain elevated. We are seeing only some mild downward movement in rental prices, which are a bigger chunk of total accommodation costs as opposed to ownership. Um, and if you think back to that chart on the Atlanta Fed, basically none of that supports lower interest rates. So I've always believed that the lowering of rates has been entirely to give US corporates in the small to mid cap end a chance to reset their rollovers, their loan maturities at an affordable rate. Otherwise, they are going to tip the economy into recession. And we're nearly there. Two more cuts of
Mm,
25 basis points each, and we're nearly there. Pretty much that's done and dusted. Thereafter, it's down to how they handle it. Uh, but I think Powell and Co have made it quite clear that after that, they're not really seeing the need for it. And I don't think they're going to be swayed by Trump. So what you've got is lower headline inflation, sticky, even stickier core inflation, and interest rates that won't even budge.
thank you. And I agree 100% that directly is related to my market forecast as well. I think when it comes to services, one has to go really down to the fundamentals. So Jabir was right that energy prices might come down, but for those who have traveled extensively in the US, you probably note that two gas stations next to each other could be offering you very, very different prices. So literally, one gas station can be charging you $4 per gallon, whereas the next door one is $3 per gallon. And both can survive. Apparently, they do have their own client base. And similarly, if you go to US today, in the past, everyone knows that there is this tipping policy, right? You got to tip your waiters, waitresses. But now it's getting more outrageous. Like the bottom line is 20%. Like you get a minimum 20% tip nowadays, whereas many people actually tip more than that. So those directly contribute to inflation as well. And that's the part that becomes stickier. Now, back to market outlook. A year ago on 28th February 2024, Jabir and I did the Q1 Outlook webinar, and we called for gold. Over the past 12 months, this is the performance of gold. It went up by 45%. So that was possibly the best performing major asset class that you can see in the market. More importantly, it was a smooth line. Now, are we going to see gold go any further, or is this the end of it? I'm inclined to the former. So, in the recent 2 3 weeks, the Chinese government has resumed buying gold.
Theo, sorry to
It
interrupt.
stopped. Yeah,
Okay. Yeah, I can see it now. Okay, it's come up.
yeah,
Okay,
sure.
sorry.
No worries. So, China or China Treasury started to buy gold again. It paused for a little while. But more importantly, China has encouraged its insurers to start buying gold. And this is different from sovereign buying gold. In the past 12 months, we have seen both Japan and China reduce their holding of US treasuries. But their reserve is not necessarily going down. So, meaning they're doing their rebalancing in the portfolio. And part of that rebalancing was benefiting gold. And that trend is likely to continue for a little while longer. Now, we are talking about the 25 outlook. I have to make this difference between short-term market performance and longer term. And I'll go on, move on to the longer term very soon. But in the very short term, things are not necessarily determined by fundamentals. It could be a lot more sentiment driven. And for now, I think momentum remains. Gold will do well. Now, next thing. This is corporate bonds in the past 12 months. Jabir showed you the spreads, right? And historically, most of investors would assume in a steady portfolio, you have to have bonds. Fixed income makes up a major portion of any portfolio, right? So global fixed income went up by roughly 2% over the past 12 months. It wasn't bad. Actually, US corporates were doing better. Now, let me show you what happened in the past 5 years. So, over 5 years, global bonds went down by 2% per annum. Meaning, for most of the conservative, neutral portfolios over the past 5 years, global bonds was a detractor, not a contributor. This begs the question, how should we perceive fixed income going forward? And this is related to my question to Jabir. Where do we see inflation? Are we going back to the zero interest rate environment? I don't think so. We are not necessarily forecast inflation to trend much higher from where we stand today, but it is not going to disappear. And most likely, we will actually stay around the central bank's target of 2% per annum. But that is not the best for bonds. Zero interest environment was the best for bonds. So what I'm suggesting is in the next year or two, we will likely see spread tighten further because fundamentals of companies are really good. But global bonds are not necessarily going to perform so much better than the last 12 months. Aviva recently did an investor survey. Most of the interviewees were institutional investors. They unanimously voted that they're going to up their games to private markets, be it private equity or private credit. But the future rebalancing will be very much tilted towards private markets. Similarly, Hamilton Lane did a survey among all the advisors advising private clients. They're saying the same. They would be suggesting to their clients that they should be tilting more towards private markets. By and large, some of these investors slash advisors are potentially seeing alternatives to global bonds or trying to get some alternatives. And this is something that I think many of our clients, our investors should also consider as well. Now, Jabir talked about the 10%. On the face of it, 10% is lower than the 25% that US is levying on Canada and Mexico. But does that mean US is buddy-buddy with China? No. You have to make it really clear that they started on different foundations and grounds, okay? So prior to these additional tax, the overall tax on Chinese imports to the US was already over 15%. So the additional 10 is on top of the 15, meaning China or goods from China are levied now after this new addition at extra 25% tariff compared to most of the other countries. Now, Canada and Mexico are worse off in the sense that they didn't have to pay much tax prior to this. and overnight there's this 25%. Of course, negotiation is going on, and they are not actually paying the 25, whereas China is actually paying the 10 now. China has also levied additional taxes on many of these American products as well. But if we go back by 1 year and I pose a question, what will be the most hated assets in the market? The answer back then would most likely be China. Anything China related, be it Chinese bonds, Chinese equities, or Chinese currency. China was so hated that no international investors would like to touch it. Here is a comparison between S&P and MSCI China over the past 12 months in US dollar terms. Ironically, the two actually delivered the similar performance despite different paths. So both over a period since the beginning of 24 has returned 29%. Now, Jabir talked about tech and whether tech is expensive or not. Here I'm comparing NASDAQ with Hang Seng Tech Index. So basically US tech vs China tech. NASDAQ being the orange line and China tech being the black line. Again, since the beginning of 24, Chinese tech companies delivered additional 10% in return compared to NASDAQ. So if you had put your money in Chinese tech companies a year ago, it would have returned 42%, whereas NASDAQ did 32. Are we done with the tech rally? I mean, it's not just from the beginning of last year, right? It was from many, many years ago. Are they expensive now? Some of the companies might be, but as a sector, no. I think you probably remember hearing from Jabir long ago about this big AI theme. That is going on, and that is going on in a big way. Yes, it possibly would remind us of the tech bubble, but as Jabir rightly pointed out, things are very, very different today compared to then. Many of the companies are doing so well. They're making so much money. But more importantly, they are going to have a meaningful impact on our life, on economy, on sociology, on how societies are structured going forward, on labor force, or whether we still need 50% of the population being in labor force or not. So that is going to have a profound change. But that profound change started already, and it has impact on market already. Here, let me give you one example. If I do a survey right now, how many of you on the call have heard about a company called Duolingo? Duolingo is a 20 billion market cap company. It is an online language learning application that you can download to your iPhone or Android phone. There are hundreds of millions of users using it now to learn languages, like various types of languages. That doesn't sound sexy, right? It is one of the best performing AI related stock in the market because the company uses artificial intelligence so well to keep the users on the app for as long as they can. The users are addicted to the app in a similar fashion as how teenagers are addicted to TikTok. So the company actually used many technology methods directly in its business, which contributes significantly to the top line and bottom line. And this is how AI is becoming meaningful. It is contributing to the performance of these companies, and it is changing our lives. Now, I don't want to spend much time on semiconductor or large tech conglomerates like be it Meta or Alphabet. I want to show you that even when it comes to a theme like AI, there are still many, many peripheral sectors and names that can benefit from it. It doesn't have to be the hardcore tech company that does the LLM, that does the big model for artificial intelligence. In addition to Duolingo, let me give you another example. I'm sure many of you wear sunglasses, and one of the favorite brand is Ray-Ban, right? So the parent company of Ray-Ban is specialized in making glasses. Glasses companies globally, be it from China, Korea, or US, or Europe, performed very, very strongly in the past 12 months, thanks to this wave of AI. So for those who know Ray-Ban, they started making AI related pair of glasses together with Meta, and that has become one of the best selling products in the market today. More importantly, it's financed by your healthcare, your Medicare in many markets where it is being sold. So yes, the list price is probably a few $100, but many of the consumers are not paying that much. And that's the interesting part. We are seeing the same in China. Nowadays, if you buy an e-watch or a wearable electronic, very likely you're not paying the full price. Not necessarily because the government is subsidizing it, but more because the Medicare, Medicare insurance actually treat that as medical devices. So many consumers are being sponsored by insurers nowadays. And the list can go on and on. But what I'm trying to say is there are many, many opportunities across different sectors that could benefit from this big AI move. And we don't have to be just focusing on Nvidia or Apple. Now, back to the short-term market move. Here I'm showing you Euro stocks index for European equities since the beginning of 2024. And on this slide, you are seeing the full year of 24. Performance was sluggish. I mean, it was good. It went up by about 8%. But in comparison to US equities, Argentina equities or Chinese equities, European equities didn't do well last year. But year to date, now I'm adding 2025 onto the same chart. So last year it did 8%, right? The past 40 days, European equities went up by 10%. It actually was the best performing of nearly all markets. Now, you remember Jabir talked about Germany, right? The upcoming German election. DAX was the best performing out of all European markets. But if you ask any investor in the market today, are you confident that European companies have better fundamentals than their peers elsewhere? I guess the unanimous answer is no. Many of the investors actually believe European companies are struggling. They are, by the way. So this is going back to my point on short-term market moves not necessarily related to fundamentals. This is really more about catching up with the rest of the markets, and also it's relative. Again, why were Chinese equities doing better? Because Chinese equities were so cheap. They were significantly cheaper than most of the other markets. And now on this chart, you are seeing the same with European companies and European equities. Now, again, forecast for this year. Do we expect market to crash simply because they've been up so much and they could really take a break? I think US equity are taking a break right now. But if I'm looking at the full year, 12 month, I think I'm still reasonably optimistic that equities are going to do okay, thanks to the AI theme that I was talking about. I mean, Chinese equities in the past 2 weeks were doing phenomenally well because of one trigger event, DeepSeek. Is DeepSeek directly contributing to any of these Chinese companies now? No, not at all. But it's a trigger. And in the very short term, I think I'm very positive that we are going to see more and more of these triggers appearing in the market. And they will provide support for further expansion of valuations and support the performance of equities going forward in the next 12 months as well. And I'm still good on gold. I'm good on crypto, but I know that's debatable. And I'll hand over to Jabir, see whether he has anything to add, and we will also open up for Q&A.
Great, thanks, Theo. Yeah, please, if anyone has any questions, do ask. I mean, I've got one question for you, Theo, which stems directly out of what you've just spoken about. You hit on two things, obviously, tech and specifically DeepSeek. Do you think markets have woken up yet to the full impact of tech this time round, or do you think they're still wallowing in the dot-com doom and gloom of 2000, 2001?
I think markets have not woken up fully, but not just markets, but companies as well. So back to your point on Beamer and Merck, European automakers were great examples. They are definitely not woken up to the tech evolution, or maybe part of that is related to how market itself has been treating them. I'm specifically talking about electrification as well as intelligence driving. So what happened today, for example, um, as many of you probably know, this Chinese automaker BYD, which is big in EV, and it has done very well in the most recent 2 3 years. The total output per annum is well over 4 5 million cars, which is really big number. So today it announced that it will make all of its products equipped with intelligent driving for free. So for those who know Tesla, you're gonna pay for additional $5,000 or $6,000 for the smart driving kit, right? Whereas some of the cars that BYD makes will only cost you $6,000 anyway. And they are throwing the smart driving for free into literally all cars. And that's the part where I was saying I think the European competitors are not waking up to that as yet. And so is market. I mean, most of the market participants, again, this is related to my discussion around Chinese equities. Ownership of Chinese equities outside of China has come to the lowest point. But if you look at some of the smart US hedge fund managers, they're piling up on Chinese equities now. So there's this big divide where the larger portion of the market are not necessarily aware of the trend that is actually going on already. But some of the smart money is already following that trend.
Right. There's a question that's just come through actually from a colleague Ross regarding volatility. It's an interesting one, and he said, "I always talk about volatility of the market. Is it more volatile these days, given access points for retail investors? Does the VIX measure? Does the VIX measure this accurately still?" Um, and Ross, the way I would answer that is to say the VIX index, the volatility on the S&P, is a purely reactive index. It's like a knee jerk. It's like a doctor doing that test on your knee with that instrument. That's all the VIX is. It's a pure sentiment indicator. And the things that drive it, it's a very fickle thing. It's volatility is such an odd beast. It can be something on the other side of the world that just spooks investors, because I think underlying volatility is almost like this innate desire amongst individuals, investors, to want to not lose money and therefore exit markets rather than miss out on potential increases on the back of any news. So I think to that extent, if you look at volatility today, it's doing its job. That's what it's doing. It's measuring that sentiment that's out there. Is it appropriate? That's a very difficult one to answer, because I think people over time, a bit like antibiotics, really, trying to deal with drugs, trying to deal with bugs. I think the bugs are becoming more resistant, and I think people are becoming more resistant to the things that actually cause spikes in volatility. It takes something really major for the volatility index to double in one go. The last time we had
Mm.
anything major was 2008, the GFC, global financial crisis, where I think it crossed, the indicator crossed over 80. And then the second highest from memory is 2011, when you had the whole Greek saga going on. And there was the fear that bonds, bonds were going to default. But that got averted in the end. Since then, we've had a couple of goes at testing the 40 or so limit, but we've never got close to the 80. And yet, look what's happened along the way. You've had Russia, Ukraine.
Mm.
You've now you've now got Trump wanting to get his hands on Gaza, however realistic that is or not. But nobody seems to really budge an inch on these sorts of things. You get little spikes. So the VIX index is simply measuring sentiment. That's all it is. Whether it's right or wrong, who knows? But that's all it is. It's just measuring the change in mood out there. And I think if you look at it over a period of time, what we should be saying to ourselves is, why are people becoming more resistant to volatility, or the things that create a spike in volatility? By the way, that's where option traders are finding it more challenging. That's why they can write options a lot more and then, collect premium on the back of that. But God, if they get that wrong, they get clobbered.
Well, I suppose one has to differentiate between the real technical calculation of volatility and your perception. Very often, investors get spooked simply because there's a idiosyncratic market event causing the market to go down by, let's say, 5% in the daily session. But an index like VIX tracks a much longer period of time of the implied vol. And then, therefore, as long as That daily correction that I mentioned is recovering or fully recovered very quickly. Highly likely you do not see big change in VIX at all. Whereas if we are going to a market where S&P, for example, goes down by 5% in a month, that's when you actually will start to see more changes or larger change in VIX. Of course, if that 5% drop is followed by another 5% in the
Yeah,
following month, that's where VIX will react more forcefully.
yeah, yeah, exactly. It comes to the heart of hedge ratios, doesn't it? It's if they have to adjust, then you get a snowball effect. Don't know if there are any other questions. I'm not seeing any.
We are running over time already. I would suggest that we keep the line open for another 30 seconds in case there are any other questions. But of course, as always, you're more than welcome to reach out to our Skybound team members, Jabir and myself directly, in case you would like to chat about the market. We definitely would look forward to doing these webinars and sessions more often, but at the same time, we enjoy speaking to individual clients, colleagues, and partners. But seems that we don't have any more questions. And thank you very much for your time today. We look forward to our next session.
Yeah, thanks everybody. Thank you.